This is a Momentum Media production.
The SMSF Adviser Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hello and welcome to the SMSF Adviser Show. I'm your host, Keith Ford, joined as always by my co-host, Aaron Dunn from Smarter SMSF. Hello, Aaron.
Hi, Keith. How are you?
I'm doing very well, thank you. Living the dream, back at work and everything. It's, a couple of weeks into it, so... no complaints.
Well, we can't both complain, though. We are about to take a very short break ourselves. We've been sort of powering away at getting a few things done, and then we'll take a week off or so just to recharge the batteries before things really kick off, which I'm presuming is probably going to be from about Australia Day onwards, I'm gathering, and then full steam into February, and away we go.
That's it. It does feel like not much gets done between the Christmas break and the Australia Day public holiday. Everything really gets into gear once that's passed. So, it should be interesting. I'm sure there'll be lots happening. But as we kick into things for this week, the first piece of news on the agenda is around all the submissions coming out from the financial advisor exam. So in December, the government released its draft legislation that would essentially amend the financial advisor exam so that the short answer questions would be removed from the exam. It would just all multiple choice. It also would remove the requirement that only provisional relevant providers and existing advisors can sit the exam, essentially opening it up for people that are still completing their studies to be able to sit the exam so that they can move seamlessly into their PY, get things underway. So most of the submissions that have come out, the FAAA, the Stockbrokers and Investment Advisors Association, the SMSF Association, the FSC even, the Financial Services Council, they're all essentially saying good.
And it is good because ultimately what we want to get to is we want to get to greater flexibility when we can do it and saving money in the process, because I think in reality we've moved from within less than 5 years, we've gone from just around $600 up to around $1,500 per sitting. Whereas if we move into that multiple choice scenario through the examination process, we're not necessarily diluting the way in which answers can be constructed, but it does become a far more efficient way in which they can be done, which provides greater flexibility for people to be able to do it when it potentially better suits their own circumstances as well.
Yeah, it's one of those things where if you can improve the flexibility to make things a bit easier for people and make it a bit more cost effective, you're paying less for the administration of the exam, therefore ideally, you would then be paying less per person sitting the exam, which would then have the flow-on effect of making it a bit easier for those people who are finishing up their degree to actually join the financial advice profession. And, pretty much everyone has come out in terms of associations and been on the side of making these changes. The only kind of one that even had some calls for it to go further was the SIAA, the stockbrokers one. They essentially want there to be even more flexibility than what's proposed. So it's not pushing back in any way. It's calling for a bit more flexibility that, it should be available on request or on a rolling basis is their idea. And they also want a little bit of moderation in the way that the multiple choice deals with most correct answers. So if there's two answers that are both technically correct, you don't get a mark for picking one that is correct because there was one that was more correct. So they want a bit of, they want that to be fixed up a bit instead of trying to essentially trick the candidates into getting a question wrong.
Make it black and white, no levels of grey, please.
Pretty much. That's what they're asking for.
Yeah, well, like I said, the large majority feel as though that this is the right way to go. So let's hope that we continue down that path.
Yeah, generally speaking, if government's proposals don't really get pushback, they usually just go ahead with what they're thinking. So I don't foresee much in the way of pushback anywhere, but, who can tell with these things? Something else that is on the agenda is tax cuts. So stage 3 tax cuts are still on their way. I assume at this point it's too late for the government to back out.
Oh, no, they could still decide to make some changes if they wanted to in the budget. And you are getting different schools of thought, obviously, within different parts of financial services media about, whether they're still going to be good for the economy, not for the economy, picking up the lack of indexation that sits within our tax brackets, all those weird and wonderful things. So the government at this stage does appear committed to seeing those tax cuts go through. So, I think from that point of view, at this stage, we continue the conversation on the basis that the stage 3 tax cuts are happening.
With that in mind, the idea and what we've got an article up on SMSF Adviser, of course, based mostly around some comments from Craig Day from Colonial First State, who essentially has said, you need to start planning. They're on their way. You have to look at, how they're going to affect your clients and especially in the context of SMSFs.
Yeah, and the reality is there's going to be because we're seeing a removal of a bracket, and we're seeing an increase in the top threshold from 180 to 200,000. We are going to see more cash flow become available in the hands of different individuals. So the question then becomes is what's going to happen with that additional cash flow? We are going to see naturally some people put it towards mortgages and others, but we might have a different segment of the market that we might be dealing with that will be looking to take advantage of additional contribution strategies, whether it's to look at unused catch-up carry-forward amounts if they had balances under 500,000, simply looking at the level of salary sacrifice they might be doing, noting that we are most likely going to see an increase from the 1st of July this year from the 27.5 concessional to 30. We don't know that for sure yet, but it's almost a lock that will be the case. So there's a whole range of ways in which people might be looking at utilising the benefits that they get from this stage 3 tax cut. And therefore, what's rightly been spoken about by the team at Colonial First State is start thinking about the planning opportunities with your clients in respect to the additional cash flow that these clients are going to have. Yeah,
I think I've got to have a look and see what kind of effect it's going to have on me, the tax. I don't know if it will or it won't. I should probably know that at this point, this late in the game.
Yeah, well, the reality is the higher the bracket that you're in, the greater the benefit that is ultimately going to fan out with these changes. So if you're at the top end from the income scale, you'll have a much greater smile on your face once you start doing that assessment yourself.
Yeah, so not me then. No. Fingers crossed that I get some kind of benefit out of it. I should definitely look into that. Something else that kind of came across the SMSF Adviser website this week, SMSF's investing in cars. That's on the surface of that seemed like something that didn't make sense to me, but I know you're going to explain to me how this works.
Yeah, so this is a broader part of the collectibles conversation, collectibles and personal use assets. And I'll just tell you a funny story here, because one of the things that was done at the SMSF National Conference probably half a decade ago or so now was, the 5 most unique investments that people held within their self-managed super fund. Right?
I can tell I'm going to like this already.
Yeah, but there were things like bollards down in Geelong. There's bull semen. There's a whole range of things that have there's a view as to the benefit that can be obtained by that from a retirement point of view. Now, there are obviously more commonly held sort of investments when we think about artwork and cars, collectible vehicles, and those sort of things. But ultimately, they have become much harder to own because of the collectible and personal asset rules that were introduced into the superannuation laws post the Super System Review or the Cooper Review back in 2010. So as David Basoli was saying in the article, that the car can be owned by the fund, and there are certainly some cars out there that will have appreciated in value quite substantially, but it's the way in which the fund will hold that, will ensure that the members aren't using that, et cetera, that will ultimately dictate whether the trustees are complying with the superannuation laws to actually be owning that vehicle.
Right. And so one of the notes within the article is the idea that if the SMSF owns the car, related parties cannot drive it for any reason, including maintenance purposes or to have restoration work done, because that then constitutes use of the asset, which kind of makes me think, how does the ATO keep a track of that? Because if you supposedly, I guess, if you need maintenance on it, you would have to get someone to drive it to the place or get whoever is going to carry out the maintenance or restoration work to come to the storage facility, whatever it may be, because cannot have it in the residential address. So I guess, how does the ATO even track that?
Well, I guess ultimately
check the odometer.
Yeah, well, there would be elements of, all part of the audit would be, they would be exploring a number of those and testing some of those elements ultimately to see that they, again, that the storage is done correctly, that the insurance is actually in play, that there has been no personal use. So it sounds funny when you said it, but in reality, these are some practical ways in which it may ultimately happen. So should the car therefore be towed to the specialist that is then looking to service it, do whatever needs to be done to uphold its value? So so there are some practical things that have to be overlaid in that, which therefore does make it a lot more difficult to maintain. But it's, there are rightly going to be people that have that specialist knowledge and expertise that will want to hold that asset because they can see that having a Brock car from Bathurst in 1983 was a fantastic idea to have bought 10 years ago that now has probably doubled in value or tripled in value.
Absolutely. It would be hard for those car enthusiasts to have that parked in a storage facility and just go and look at it and just, not take it out for a spin.
Yeah, absolutely. And therein lies your challenge about why you're doing different things. So, if you want to have a Bradman cricket bat in your super fund, don't get it out and start, playing 4 defensive shots in your lounge room, because you can't have it in your lounge room.
Don't get it out for backyard cricket over Christmas.
No, definitely not.
Yeah, perhaps if you're a real car enthusiast and you're wanting to invest, maybe inside the SMSF isn't for you. You might want to have an investment where you can actually drive the car, if the temptation's going to be too great. I mean, if you've got the willpower and you can avoid it, then go for your life, I guess.
Absolutely.
All right. Well, that's all we've got for the news of the week. We're going to take a quick break, and when we come back, we will be talking to Daniel Butler, who's the director at DBA Lawyers. All right. Well, we're joined now by Daniel Butler, who is the director at DBA Lawyers, and he's here to talk all about NALE and NALE. Welcome to the show, Daniel.
Pleasure to be here, and Happy New Year to everyone.
Absolutely.
Well, Dan, the topic of NALE, we are into 2024, and it is still the gift that keeps on giving. We go back to these rules effective from 1 July 2018. And this bill is still before Parliament, but we know right before the end of the year, we saw the Senate committee ultimately put forward their recommendations to try and finalise this bill. So we know that is going to introduce a 2 times multiple to small funds, so SMSFs and small APRA funds. So maybe to kick things off, give us a little bit of a lay of the land in respect to where we've got to with this and what we might be looking at as we move into 2024.
It's really good just to see where we're at, as you say, Aaron, because it's been a long journey. It's now almost 5 years. And what we will see when this legislation is passed is this upper cap. So the upper cap will be 2 times the discount, or 2 times what should have been charged under an arm's length transaction. And let's say it was a $2,000 discount. So we double that that's $4,000. So you'll be taxed at 45% on that $4,000 as non-arm's length expense. That's NALE. So, when we say NALE as compared to NALI, and NALI being non-arm's length income, but as we all know, NALE leads to NALI.
Mm-hmm.
Yeah, so where we're at, we are really looking at the legislation coming in where the upper cap will be there, and that upper cap will be welcome. It's welcome relief, but it's really short of what the SMSF industry expected and requested. So overall, we're happy, but we're unhappy.
Yeah, and I think that's a really good point, because a lot of the feedback from industry has been, are we trying to introduce something that's not really a problem anymore when we think about it in some respects? And correct me if I'm wrong, but one of the views that was being put forward was, if we're looking to isolate this within the self-managed super fund and small APRA fund space, would we have been better off maybe putting something into the operating standards of the SIS Act and regulations, and therefore looking at it under Section 109 that would deal with an arm's length dealing, and noting that we have contribution rules and other mechanisms that would ultimately deal with this? And maybe, again, get you to comment on why that path might have been appropriate, and why the government hasn't necessarily seen that as being an appropriate way forward.
Look, good points there. There were a number of submissions made by various organisations and bodies, and the SMSF Association, the Tax Institute, CPA, the Chartered Accounting Body, and others. And they were really, putting forward alternatives, because they did see the expense hitting the NALE as unnecessary. Because if we go back in history, what really started this off, what kicked it off, was the nil or no interest LRBA. So it was those borrowing arrangements, and that really hit the peak in 2016. And we all had to, those that had non-arm's length LRBAs in place had to bring them in shape by the 31st of January 2017. So remember, and the ATO then were very helpful. They issued that Practical Compliance Guideline 2016/5, and they said, look, get your house in order, make sure you're on the monthly principal and interest repayment in accordance with the key factors, or have other arm's length material to benchmark to, if you want to stay outside the safe harbour in that PCG. So it was those LRBAs, and that was really a limited sector of the market, and that had really been cleaned up by that PCG. So the ATO did a fantastic job. We really, take the ATO should take credit for cleaning up that end of the market. However, even though the legislation initially came out to really hit those LRBAs, and the first consult paper from Treasury was all about the limited recourse borrowing arrangements, it didn't take long for the, particularly the ATO, just to sort of read the legislation to say, hey, this could have more wider application. And then we found accountants who are doing discounted or no fee services to their funds, or other advisors could be within this legislation. So initially, when it was envisaged, it wasn't envisaged really to hit this. And as you said, then, there are other measures for dealing with this, like contributions. And indeed, where we are today, it's still hard to distinguish between what is a lower expense and what is NALE. And we'll give you an example. Like, the example is, a classic is the employee share plan. With an employee share plan, typically, if you're an employee of that employer, you as an employee get the discount, whatever it might be. And that discount might be, say, 25% off the market. So you as the employee get the discount. So under a number of these employee discount arrangements, you can nominate the fund. And when you nominate the fund, it's taking advantage of the discount. And fair enough, you are taxed individually under the tax provisions as receiving a gain. But once you nominate the fund and the fund's only paying the discounted price, the fund would not get that price but for the relationship with the employee. Now, in the past, the ATO has just treated that discount as a contribution in accordance with that long-established ruling. Again, a very good ruling from the ATO, being TR 2010/1. So with that ruling, the ruling was if you underpay for an asset, it was a contribution. And that's what we've lived to today. And still, the ruling is still there. And we may remember in 2011, it was 2021. In July 2021, they issued a consultation redraft of that ruling, TR 2010/1/DC, draft for consultation. And in that, they were sort of working out what was some of the divide between what is a contribution and what is NALE.
How you going, Keith? How's your head?
All extremely straightforward stuff there, it just absolute layman terms. I really appreciate it there, Daniel.
We're trying to be as straightforward as possible here.
I think it is actually fairly important. That point, though, is this is very technical stuff. This is not easy to wrap your head around. And so if you're a trustee who's trying to figure all of this stuff out and you're not working with an advisor or an accountant that understands this really well, I don't know what the hell you would do.
Yeah, and I think that one of the challenges here is understanding the differences, because you've got professionals like accountants and lawyers and financial advisors who have their own self-managed funds that are actually caught within this net. And then you've got others, clients like you've got builders and all those sort of people, which equally get caught in this net. So it's quite fascinating. Dan sort of touched on before, one door closed, we get a ruling, and then we get the ATO starting to interpret this, and it actually blows out a whole heap of windows out the back of the building because of the fact that the ATOs then looked at the law and applied it to a whole range of other circumstances that are happening within the industry.
Well, and Aaron, if we look at that issue about the divide between what is NALE and a contribution, the ATO's view now appears to be, or when I say ATO, reinforced to a certain extent by Treasury's view in the legislation, is that any asset purchased lower than the market value is NALE. And you've got to be very careful, because then we get into the distinction between a specific NALE or specific NALE. And when it's specific in relation to a particular asset or revenue source, there's no upper cap. It's just everything is tainted. And that's one of the dire consequences. So I've just written an article for the Tax Institute, and in that I've put, look, technically a $1 discount could have you into NALE. It's just really extravagant. And then the asset is tainted for life.
Yeah, and that's where we've started to see these market substitution rules come in, and being able to isolate, if you are making it as part contribution under an allowable acquirable asset, that you need to document that is the case. Whereas previously, as you rightly were saying, if it was $100,000 off-market transfer of a listed share, for example, and you made $50,000 of consideration, well, the other 50 would simply be deemed to be a contribution in respect to that individual. Now, that's not the case unless you actually document that to be the case. And those market substitution rules will come in, and the non-arm's length income requirements.
And that's right. And that was actually what the ATO outlined in that 2021 revised TR 2010/1. They did say if you have a contract to purchase real estate, then if it's part of the real estate being acquired, you should express that in the documentation at that time. Because what they said was they won't accept if it's for the whole asset, it's less than market value, it would be into that NALE area.
So the other thing, Dan, I think going through and people trying to unpack this is that, and we've sort of jokingly sort of made comment already about the 5 or 6 years down the track, but what are the current impacts of the delays at the moment with these measures not yet being finalised? And then I guess the second part to that is, well, once they do get finalised, when and how do they then become effective?
Well, I think that's a very important point. Now, this is a can that's been kicked down the road already for 5 years. Our legal system here is a mess, and that is, we're advisors. We have to advise people on the state of the law today. So the state of the law today, and this is how ridiculous it is, as an advisor, the law today is a $1 discount, a general discount will blow up effectively the fund. That is, not only small funds, but large funds are exposed that a $1 discount could technically taint the whole fund with 45%. And we put that in perspective of a large fund. So you think I'm just crowing on as a lawyer, but I'm saying in reality, we deserve better as an industry. We deserve clarity. And it's already been 5 years. We're talking about 5 years of stuffing around, 5 years delay, a lot of professional time by all these professional bodies being input to government, to Treasury, to the ATO to get this right. And in the end, we get one little change. And where we are today is it's ridiculous today that the law has this gaping hole in it. That is, we haven't got clarity because the law will change. And when the law does change, and the soonest it can change, and that's assuming the legislation is passed by the 31st of March, is 1 April. So we're out to 1 April. And as you know, Aaron and Keith, the ATO's practical compliance guideline to say we're not applying resources to a general expense NALE, we're not taking action on that, that ceased on 30th of June 2023. So there has been some request to the ATO to say, look, given this hiatus, given this great uncertainty, and it's really bad for us advisors that not only, we have to tell clients at the moment they could be hit up very badly and blow up their fund, but they have to wait for this legislation to come in. And when the legislation comes in, then we see the upper cap of 2 times, and that is retroactive. So it should be retroactive, but in the meantime, if the ATO is going to uncover you, does the ATO apply the current law, or do the ATO do it on the basis, well, they'll expect the proposed change to law to be introduced? And I just say, as a lawyer, that is just totally unacceptable to our community. And I cannot believe how the industry has tolerated this so far, because, something more should be done. Government should really see this as a serious matter. And it's just totally unacceptable for our industry, such a large industry, to be treated like this. It's like a slap in the face. It's like, even more, it's like a big kick in the guts.
And the one thing that's frustrated me, I think, Dan, throughout this entire process is we have seen ministers in the past be very forthright in their views about coming together as an industry to try and find solutions. And I think this is the perfect example where we had collective views across multiple disciplines, across multiple organisations, that then created working groups to come up with a solution. And then ultimately we came up with, well, the industry didn't come up with this. This was Treasury's idea in terms of what they introduced. So there is a sense of a bit of a kick in the guts in it, because you're telling us as an industry to go down one path. And as you said, the amount of hours and resources that have gone into this from the various professional bodies and those that support the bodies and so forth to get to a position, for it to ultimately amount to nothing, really does, bring forward a level of disappointment and therefore, the way in which we might feel like we want to consult in the future.
Well, what it does, and it shows a lot of lack of respect and trust for the SMSF sector, because the SMSF sector, we're all saying, look, we know there's a valid role for NALE and NALE. But if we go back to cases, and we have a number of cases, and the cases are very extreme. The cases are, like in one case, is a GYNW, and that was a case in 2019. And the accountant paid $200 for some shares. And on that $200 investment, within 3 years, there's a $1.8 million dividend return with about 770,000 franking credits. Now, you can just imagine you buy an investment for $200 and within 3 years, you're looking at a 1.8 million return plus nearly 800,000 of franking credits. Like blind Freddie would pick that.
Yeah, sounds like a great investment.
Yeah, great. We'd love an investment like that. I think I'd even be happy to pay the tax to have that investment, but I wouldn't have put it in my fund.
Yeah.
But then there was another one, Darrell N. And in Darrell N in 2010, an executive purchased shares in a private company which owned public company shares for 10% of the market value of those shares. And similarly, for a $50,000 investment over a 9-year period, that almost returned $700,000. So it's not too bad if you can make a 50,000 in 9 years, 700,000 return. So that's, multiple return. Again, it's right in your face. This is NALE. And then when, this came out as NALE, we're talking about a discount of, look, technically I'm saying $1, and it would be great if there was some de minimis that below a certain threshold, you're safe, but there's no de minimis. Like, I'm just using $1 as an example. I know the ATO wouldn't, hassle about $1, but technically I'm trying to explain the law here that it's outrageous that there's so much potential dispute. We don't even know what is the difference between a contribution and NALE. And then we get into all these other crazy things like, okay, let's say, Aaron, you're doing something for your fund. Are you doing it as a trustee or are you doing it as an individual? Now, using some of your resources.
Yep.
And then we talk about, look, if Aaron's using some business, professional employment or occupational resources or tools, that could taint his fund with this NALE. And that gets hard. That gets very hard.
Yeah, and we're even seeing private binding rulings sort of coming out now quite often since the 1st of July last year on both sides of the fence in respect to whether you are wearing that trustee hat and therefore the NALE issue is not an issue, or in respect to actually you are doing this in an individual capacity. So getting that clarification, I think, tidied up very soon is naturally going to be beneficial for everyone.
Yeah, and I think this is where advisors really need to look at their own homes first. That is, okay, are you giving yourself a discount through the firm? Because if you're giving a discount or leveraging off resources, be very careful. Have you got a documented staff discount policy? Because it's not too hard to go out there and benchmark your staff discount policy. However, one secret, don't benchmark it to the, some of those suppliers say first year free, we'll do first year free. Get a comparable type of benchmark, document that benchmark, document your policy, notify staff. It says staff, directors, shareholders, etc. So notify the relevant parties and have that as a documented policy for your firm. So if you're giving, say, 50% off, have some benchmark to document that, and hopefully that should be fine. Right. But one thing I really like is, I wrote an article a while ago. It was on the ASIC fee. So those with a corporate trustee.
Yep. And
I'm a big believer in having a corporate trustee. And with the penalty, I just wrote an article the other day, and this is on a penalty unit. The penalty unit is going up to just below $20,000. Now, here am I, if I get a parking fine for $85, I'm livid for at least 1 week. Now, if I get hit with 20 grand, I'm really furious. And this is a common sort of on-the-spot fine for an SMSF trustee who breaches one of these admin penalty provisions. So you've got 20 grand that could hit you very easily, but this may not be so much of an admin penalty, but we're looking at NALE, and with the corporate trustee, you can actually have a one level of that admin penalty. Whereas if you've got individual trustees and you've got 2 of them, double that admin penalty, you're up to 40 grand, up to 6, you're looking at 120 grand for a one item penalty. But in addition to that, what you really want to be aiming for is a sole purpose corporate trustee. And the reasoning behind having a sole purpose corporate trustee, and this is another issue which really brings out the real level of detail we have to look at in our practices, is the current fee for a annual review of a company with ASIC is $310. If it's a sole purpose corporate trustee, it's $63. So a lot of people have a corporate trustee that does more than just the super fund. It's doing the company or the family trust or some other role trading in its own right. So in this instance, you've got all these people with corporate trustees. And my question to them, where the corporate trustee has more than one role, is who's paying the ASIC fee? Because how many people get down to splitting hairs? And what I mean by splitting hairs, well, $300 is not a big amount, so you wouldn't think of looking at it. But under NALE, you've got to go and look at your clients and say, hey, if it's a $310 ASIC fee and that's paid by someone else, the super fund may have been subsidised. And in that subsidy, that's an expense that's lower than market value. They're not dealing at arm's length. That therefore will hit them up with NALE.
Yeah, and the potential accounting fee that went with that to be able to provide the corporate secretarial that may have gone with it as well.
Correct. So you see, the level of detail here is it's just beyond a joke, without a de minimis. And I just don't think people have seen the tsunami of this NALE, NALE. It hasn't affected a lot of people to date, but with the new rules in place, practitioners just have to be really on the alert.
So I think, Dan, just to summarise that then is, once we get the finalisation here, we're naturally then going to see the ATO look to update their law companion ruling and how practical they look to provide some detail in there. Things like de minimis and stuff, we hope, but I guess we'll go through a period of consultation again. But, at the moment we have a piece of legislation we've been waiting for a heck of a long time. We might not be entirely happy, but it's not the world's worst outcome in the end, considering where we are currently, where we could have been and where we've ended up. But ultimately, we're going to then have to wait for the ATO to finalise their position as well. And then we might all be able to move forward.
Yeah, and the real unfortunate casualty in this is a very reasoned and valid request by industry, both from the SMSF sector and the large fund APRA sector, was let's forgive honest and innocent oversight. So if you make an honest and innocent oversight, and we all love that example of Trang. Trang, the plumber, Trang, the female plumber,
yep,
goes and does a bit more than a fix, actually renovates the kitchen and bathroom, and the rental property in her fund is tainted for life. Now, Trang might have done that with the belief of doing the best by her fund.
Yeah, building retirement savings for her, all that sort of stuff.
Yeah, just doing it, and it's a natural thing to do.
Yep.
A natural thing that a person will want to do. So Trang's done that to her fund, and probably without any knowledge about these complex rules we're talking about. And as a result of doing that, she has now tainted that property forever. There's no fix. So that property is tainted forever. So this is the real nasty about specific expenses. A specific expense taints that asset for life. Now, you mentioned the Senate Committee review report before, and a Treasury official commented on why the anti-avoidance provision should not provide a let-out for honest and inadvertent oversights. And he quoted, quite surprisingly, that this would disincentivise the behaviour or the mischief that they're designed to prevent. If a trustee had the ability to rectify any NALE, then there would be, in effect, no disincentive for that behaviour. It's appropriate. So that's what he put forward to the Senate committee, which I think is totally wrong.
Mm-hmm.
If we look at it, an anti-avoidance provision, as we said, the industry was quite comfortable. There is a role for NALE. It's then a matter of how you play it. And as we said, the industry did put forward treat it as an arm's length matter under SIS, and that would lead to contraventions under SIS because that is more appropriate. Or treat it as a contribution, and if it's a contribution, it then gets you into contribution rules, a 15% tax, the Div 293% tax, then the excess contributions tax. So they might even collect more tax out of the contribution than they would under NALE. But I put forward in response to that Treasury comment that this is quite different to a lot of anti-avoidance provisions. This NALE is nasty because it taints the asset for life. We gave the example of Trang. Trang innocently, maybe innocently, tainted her property for life. There's another example that came out in the revised EM. It's Sam. And Sam does $3,000 of improvements to the rental property. And again, that's tainted for life. Now, do you think $3,000 should taint a property for life?
Yeah, no way.
Yeah, and that's crazy because, these people, to be human is to make errors. To err is to be human. So humans are bound to make errors and oversights. Not everyone's out there paying advice, particularly in this financial situation we're in. People are really tight-fisted in paying for advisors to get advice. So we put forward that there should be this discretion in the ATO to relieve people where it is an innocent or innocent or inadvertent oversight. Now, the other pointer was, with Part 4A of the 1936 Tax Act, the commissioner must make a determination. That is, the commissioner sees the situation, sees there's been any avoidance behaviour. Okay, I'm going to issue my notice. This is my notice under Part 4A. But under NALE, NALE, it's automatically invoked. So the commissioner doesn't have to do anything. And given this is not black and white law, given all the complexity of this law, even the topics we've talked about today, it really is a Pandora's box that there is going to be a lot of innocent and inadvertent oversights that people are getting into this, and there's so much room for a dispute. Let's take a market value. Okay, you get a market value appraisal and it's between 1 mil and 1.2 mil. Which part of the line do you go in? Do you go 1.1? Do you go up the top end? Do you go at the bottom end? You've got to justify your position. So there's a lot of room for dispute. And we've even had situations where we have had matters that, we have worked on many assignments on NALE over the years. And look, this is a matter out there. It's not a matter that's, some advisors may not have come across, but it is happening. It is a growing area, and it's certainly a risk area for advisors they need to be on top of.
Yeah, it certainly sounds like something really, really easy to deal with. Yeah. It does it comes back to the kind of the motto of our show here, which is asking for clarity. Advisors and everything, that they just want to know exactly what the rules are that we need to deal with. And it certainly sounds like this is one where that clarity just does not exist at the moment.
Well, it doesn't, unfortunately. And look, even an advisor like me, I really think I'm an expert in this area, and as you probably are too, Aaron. Yeah. But to give clients the clarity of guidance, say, hey, this is a contribution, and this is why it's different to NALE or NALE. And to say, look, if you do these steps, you will be safe. But there's very little you can do there because this is something, it's really something the ATO they may not get you on the regulatory provisions under SIS, so they might say, we'll do them on NALE. And then it's reverse onus of proof. You've got to go in and dispute it. So we're not saying the ATO does it, but we're just saying it's just not fair for the taxpayer's position that there should be a bit more protection there, like there should be the need for a notice to issue, there should be this honest and inadvertent discretion given. It shouldn't be like if it's just a little bit of NALE tainted, it taints that asset for life. And when you're talking about a company or a unit trust, all of the distributions are also tainted, including potentially the capital gains. So this is really, it's a really big issue in the tax area that's why, the Tax Institute was very a leader in the group here, as well as the SMSF Association, in getting, submissions forward to government and trying to work with government to get a fair result.
Well, I think it'd be fair to say we could sit here and talk forever, much to Keith's enjoyment, I reckon, no doubt Dan as well. So I guess on behalf of Keith and I, it's great to have you on our SMSF Adviser Show once again. Thank you. Your contribution is always greatly appreciated, not only amongst the two of us, but obviously the broader audience as well. And no doubt I'll catch up with you at the SMSF Association National Conference next month.
Look forward to it and have a great year ahead.
Excellent. Thank you.
Thanks, Dan. All right, we're back now. Just myself and Aaron here to wrap up the week. Aaron, what was your most interesting, either from the news of the week or I guess from our conversation with Daniel?
Oh, I think the conversation with Dan is always very insightful. Obviously, he's well respected in the industry, plays a very close role in the ongoing consultation with these issues. And I think you can hear it in his voice as we spoke through some of these issues, the level of frustration that this issue has driven, I guess, in not only him but across the industry. And yes, there has been opportunities to discuss matters as we went along, but for all the effort, we haven't come up with an outcome that has, fine, it's an acceptable outcome, but it's not necessarily the outcome that the industry would have liked. And now maybe the government will argue, well, the perfect, and I think we've spoken about it on here, that the perfect way is if no one's happy, then it's actually the correct outcome that we want. But I think from that point of view, it's really understanding the nuances that he highlighted in it and the frustrations that have come from that, to say that, sure, we might have a solution, but it actually hasn't fixed everything. and therefore how we might deal with some of those other issues is going to be important, and how the ATO might respond to some of those through their updated guidance will be fascinating to see as we move through 2024 as well.
I guess the quicker it gets implemented, the quicker it gets around to the next phase of trying to fix it.
Yep, 100%. 100%. And what about you? Given that you're probably glazy-eyed for a lot of that, as Dan and I were sort of going through the technical elements of it, what did you take away from it?
I certainly hope that I learned something from the conversation there. It's definitely a complex area, and one that I'm not going to pretend that I understand fully. But, just the idea of just quite how punitive a relatively minor transgression of these rules can end up being, and the way that it, taints that asset for the entirety of the time that you own it, and or just for the life of the asset, and then there's just no recourse and there's nothing you can do, and you just got to kind of eat the penalty. Yeah, it does seem quite onerous, and I guess for some of those innocent mistakes that you guys were mentioning, perhaps a bit unfair. So,
yep, absolutely. Well, as is always the case, if anyone has any suggestions on topics, speakers, or otherwise, how can they get in contact with us?
That's it, editor@smsfadvisoronline.com.au, and hit us up with everything that you've got for us.
Excellent. Well, thank you once again for joining us for this week's edition of the SMSF Adviser Show. Whether you're back at work or still on holidays, we'll catch up with you in a fortnight's time. Take care. Bye for now.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.